Welcome everybody! In this video we try to give a simple explanation on why you should invest your money. To start, there exist various forms in which you can invest your money: stocks, real estate, pension funds, education, bonds and much more. We will cover the most common forms and its pros and cons in a different video. In this video, however, we want to understand why you should invest your money. To answer this question, we must first understand what inflation is. In one sentence, inflation is the decline of purchasing power of a currency over time. Or we can say it the other way around: inflation is the sustained increase in price levels. This means that 20 years ago you could buy more with $10 than you can do today. The value of $10 has decreased and/or the price of the goods has increased. There can be many reasons for inflation, however, that is not the point of this video. Here are just two of the most common reasons. The first one, too fast economic growth, the so-called demand pull factor. The second one is the so-called cost push factor. Over the last 90 years, the average inflation rate in the US has been 3.1%. This means that on average the purchasing power of the dollar has declined by 3.1% per year. In other words, price levels have risen by 3.1% per year. Based on this, we can say that $10 in 1999 is worth about $15 today. In other terms, what you could have bought for $10 in 1999 costs about $15 today. Of course, there are goods that have become much cheaper or much more expensive, but on average, price levels have risen by about 50% from 1999 to today. And this is significant. Now that we understand that money on average loses 3% of its value per year on inflation, since prices increase by 3% per year, we found the true reason why you should invest your money. Because if you don't, your money will lose in value. Let's imagine you have $20,000 saved up and you hide it in cash under your bed. In this case, this $20,000 would lose 3% of its value every year. After 1 year, it would no longer be worth $20,000, but only $19,400. In other words, 1 year later, you can only buy things worth $19,400 with your $20,000 under your bed. If you leave your $20,000 under your bed for not 1 year but 10 years, then your money has only left the equivalent in purchasing power of $14,000 10 years later. You lost 30% of its value to inflation by doing nothing with your money. Consequently, if you don't want to lose money, it must be invested in order to increase it and to counteract inflation. The simplest example is a bank account. If a bank account promises you 2% in interest, your $20,000 that you now have in the bank will grow in value from $20,000 to $20,400. That sounds good, but since inflation will lower the value by 3% and you only receive 2% in interest, your cash has lost 1% in total value. And now, after those few simple examples, we can answer the initial question of the video: why should you invest your earnings? You should invest your wealth so that it can increase in value and make up for or even exceed the 3% average annual loss in value due to inflation. Otherwise, you will lose money every year. The next question immediately arises: where is the best place to invest your money in order to increase the value? If you use the example mentioned at the beginning, we could look at the return on your investment and see what percentage which investment has returned. However, this we will do in the next video. Thank you very much.